Most people think student loan debt is just a number. It is not. It is the invisible hand quietly deciding where you live, who you marry, when you retire, and what risks you are ever willing to take. Your loans did not just cost you money. They rewired your entire future. Like this video and subscribe, because what comes next might change how you see everything. For as long as most of us can remember, the message was the same. Go to college, get the degree, and everything after that will fall into place. It was not just advice. It was presented as a guarantee. A contract between you and the future. Work hard enough to get in, take out whatever loans you need to stay in, and the reward waiting on the other side will make all of it worth it. And millions of Americans believed that, because why would they not? It came from parents, from teachers, from guidance counselors, from every adult who seemed to have figured it out. But here is what nobody mentioned on graduation day. The average American who graduates with a bachelor's degree today leaves school carrying around $37,000 in federal student loan debt. Under a standard 10-year repayment plan, that translates to roughly $350 to $400 every single month, without missing one, for a decade. Now, picture yourself at 22 or 23 years old. You just landed your first real job. You are proud of yourself. You should be. But before you ever see what freedom feels like, $400 is already gone. And that is before rent in Chicago, where the average one-bedroom apartment runs close to $1,800 a month. Before groceries, before health insurance coming out of your paycheck, before anything. This is the moment most people start doing the math for the first time in their lives. And the math does not feel like what they were promised. This video is not here to make you feel worse about that. It is here to name something that most financial content never touches. Because the student loan crisis in America is not only about the balance sitting in your account, it is about what that balance does to your mind, what it does to your choices, what it does to the version of yourself you were supposed to become. The debt is not just a financial burden, it is a psychological one, and that is the part nobody warned you about. Most people only ever look at the balance. They watch it go down slowly and tell themselves that as long as they are making payments, everything is fine. But the real damage is not happening in the number. It is happening in the decisions, the ones that feel completely rational in the moment, but are quietly being made by the debt on your behalf. Let me tell you about Kai. Kai graduated from Ohio State with a degree in communications and $38,000 in federal student loans. Kai was not reckless, was not naive, did everything that was asked, studied hard, graduated on time, applied for jobs before the ink on the diploma was dry. By every measure that was ever presented, Kai did it right. But then, real life started, and real life had a monthly payment attached to it. The first place the debt showed up was in Kai's career. Right out of school, Kai had two offers. One was from a non-profit doing communications work for a cause Kai genuinely believed in. The pay was modest. The other was a corporate marketing role at a mid-sized company. The pay was significantly higher. Kai took the corporate job, not because of passion, not because of ambition, because $400 a month had to come from somewhere. Researchers call this debt-driven career lock. It works the same way healthcare job lock works, where people stay in jobs they dislike because leaving means losing insurance. With student loans, people choose careers not based on meaning or fit, but based on what the monthly payment demands. Kai never framed it that way. It just felt like being responsible. Then came housing. Kai spent years assuming that buying a home was simply not possible yet, and in a very real sense, that was true. Studies show that student loan debt delays home purchases by an average of 4 to 7 years for American borrowers. The debt sits inside the debt-to-income ratio that lenders use to evaluate mortgage applications. Even with a decent salary, Kai's monthly loan obligation made the numbers look wrong on paper, so Kai kept renting, kept paying someone else's mortgage, kept telling friends that buying a home was just not the right time yet. Then there were the relationships. This one is harder to measure but easier to feel. Kai avoided certain conversations about money with partners, felt a quiet shame when the topic of finances came up too early, made decisions about moving in with someone or thinking about the future based not on emotional readiness, but on the low hum of financial anxiety that never fully went away. Kai never talked about this with anyone. Most people do not, because admitting that debt is shaping your relationship feels like admitting something is broken inside you rather than inside the system. And then there was retirement. Kai's employer offered a 401k match up to 4% of salary. Kai was only contributing 2% because anything more felt impossible given the loan payment. That gap is not a small thing. A person who invests invests consistently in their mid-20s, even modest amounts through a Roth IRA can accumulate close to $400,000 by retirement through compound growth alone. Every year, Kai delayed that contribution. The window for that kind of growth got a little smaller. The loan payment was not just costing Kai money now, it was reaching forward in time and taking money from a future version of Kai who had not even arrived yet. The realization did not come as a dramatic moment. It came quietly. One evening, years into the job and the apartment and the payments, Kai sat down and started tracing back through the major decisions of the last few years. The job, the city, the relationship choices, the retirement contributions. And Kai noticed something that was difficult to sit with. Almost every major fork in the road had been shaped in some way by the weight of that loan balance, not consciously. Not with any awareness at the time, but the debt had been in the room for every single decision, and Kai had never once noticed it was there. Here is the shift that most financial advice completely misses. The goal is not to pay off your student loans as fast as possible. That might sound strange coming from a video about debt, but the real goal is something different. The real goal is to stop letting the debt make your decisions for you. Those are not the same thing. One is a financial strategy. The other is a psychological one. And for most borrowers, the psychological one matters more. Because here is what aggressive repayment without a broader strategy actually does. It keeps all of your mental energy focused on the number. It keeps the debt at the center of every decision. It keeps you reactive instead of in control. And it often means neglecting everything else. The retirement contributions, the emergency fund, the career move that actually makes sense in service of a payoff timeline that may not even be optimal given your situation. The American federal loan system has tools built into it that most borrowers never fully use. Income-driven repayment plans cap your monthly payment at a percentage of your discretionary income. That one change alone can immediately free up cash flow and reduce the psychological pressure that has been driving decisions like Kai's for years. For borrowers working in public service, government, or nonprofit roles, the Public Service Loan Forgiveness Program can eliminate remaining federal loan balances after 10 years of qualifying payments. That changes the entire calculus of which job to take. It gives people like Kai permission to choose the nonprofit. For those with private loans, refinancing can lower interest rates, but it should be done with eyes open, not out of panic, and never with federal loans where it means losing income-driven repayment protections. These are not tips, they are levers, and knowing they exist changes the relationship you have with the debt. It moves you from someone the debt is directing to someone who is directing the debt. Now, step back from the numbers entirely for a moment. The student loan crisis in America is not a story about a generation that was reckless with borrowed money. It is a story about a system that sold a product, one that costs more than most American families earn in an entire year, to 18-year-olds who had no framework, no financial education, and no real ability to evaluate what they were agreeing to. The marketing was everywhere, the warnings were nowhere, and then the bill arrived, quietly, reliably, every single month for the next decade. The damage is real, but it is not just in the balance. It is in every quiet compromise that came after. The job taken for the wrong reason, the home delayed, the conversation avoided, the retirement account sitting just below where it should be. There is a difference between carrying debt and living inside it. Carrying it means you know it is there, you have a plan, and you have made peace with the timeline. Living inside it means it is in the room for every decision you make, without you ever realizing it walked in. Most people with student loans have never been carrying them. They have been living inside them. That is the thing worth changing.